coming up with Omnia now, which was founded in 1953 and manufactures explosives, fertiliser and general chemicals. It has a market cap of 9.8 billion rand, a PE ratio of 16.25 and a dividend yield of 2.37%. I've always thought of these guys as a very well-operated business.
I think it's a well-run business in a terrible sector, quite frankly.
I mean, they almost had a perfect storm. You know, terrible agricultural environment with the drought and terrible mining environment. And yet they still managed to sort of eke out a profit and pay dividends and, you know, carry on with business.
As we spoke about earlier on, it's a very, very well-run business. About 40% fertilizer, essentially, 40% mining, essentially, and then they've got some specialist chemicals, protea chemicals coming in. Now, when you read their latest report, you would actually think they'll be more bullish, because agriculture clearly has turned, and mining, as we spoke about earlier.
The prices of the crops have come down a lot.
The prices have come down, but on their side, they got big volume increase, but virtually no sales increases, because the prices obviously of what they're supplying there has come down, and they were quite muted in their outlook for agriculture. I mean, you would expect them to be extremely bullish, because volumes are massively up, but obviously they're under pressure on
and not just in South Africa, because they're all over the continent. You know, Africa has 60% of the world's arable land. There's huge potential throughout the continent.
Ultimately, that's going to be the true growth in the African economy, is actually agriculture, based on the back of massive protein demand out of China. But that might be a 10 or 20-year story. It's not an immediate story.
So now agriculture is their biggest revenue driver, but it's only about 5% margins. Whereas the mining side of the business, lower revenues, but much better margins.
Yeah, and they've also expanded a lot into Africa, and certainly the volumes are at least stable to looking better, and the margins are actually quite good. So it's actually quite a nice business to be in, but obviously it's cyclical.
And they seem to be more geared towards open cost type mining, which is less labor intensive.
But lots of explosives.
Yeah, lots of explosives. So it's a position they want to be in. And a lot of South African mines with the recent labor issues are heading towards mechanization and open cost type mining.
Yeah, very much so. And this is their particular niche. But, you know, as we said earlier on, it's very good management in a tough industry. And what worries me about the share price is this has got a big rating, and judging from their outlook statement, I can't see an imminent surge in earnings to justify the rating.
And they seem to be in the pipeline, a petroleum refinery business that they're looking to purchase. I had a look at the recent cents, and it's pretty confusing, because this business is so heavily hedged with their dollars. It's actually more the currency movements that determine the profits of the business, which always makes it very complicated.
But obviously they will benefit from rand weakness. You know, whether I would want to go into petroleum refining, because it's set margins, Although I suppose it's a reasonably good annuity generating, because you don't actually buy the oil and then sell it on. You just refine for a margin. So, you know, maybe it'll be interesting to see what they do.
It's nice for them to diversify their business slightly. And if they continue their good management history, then they should be able to take an asset and do well with it.
Yeah.
So hot or not on Omnia?
No, I think the rating's too high.
Yeah, I'm going to agree with you. 17 times earnings for a business in a tough sector, maybe a little expensive.